You know what's wild? Right now, somewhere in America, there's a couple sitting at their kitchen table with a real estate agent telling them this is the perfect time to buy. Interest rates are down from their peak, inventory's finally moving, and if they just stretch their budget a little, maybe go from 400K to 485K, they can get the house they really want. And they're nodding along, feeling that pressure, that urgency, because everyone keeps saying the same thing: buy now or get priced out forever. But here's what nobody's telling them. The housing market isn't just cooling, it's about to flip in a way we haven't seen since 2008. And I don't mean a little dip, I mean a structural change that's going to catch millions of people completely off guard. I'm someone who spent years studying how wealth actually works, not the Instagram version, but the unglamorous math that separates people who build real financial security from people who just look like they have it. And right now, we're watching one of the biggest wealth transfers in modern history set itself up in real time. The only question is which side you're going to be on. Let me show you what's actually happening. So first, let's talk about what everyone thinks they know. The narrative right now is pretty simple. Housing prices might soften a bit, rates might come down a little more, and things will stabilize. Maybe we get a buyer's market for a year or two and prices flatten, and then it's back to normal appreciation. That's the story. That's what most people are planning around. But that story is missing three massive factors that are converging right now, and when you see them together, the picture changes completely. Factor 1, the demographic cliff. Baby boomers own about 42% of all real estate wealth in this country. That's roughly $18 trillion in housing equity concentrated in one generation. And over the next 10 to 15 years, a huge portion of that is going to hit the market, not because they want to sell, because they have to. Downsizing, moving to assisted living, estate sales after they pass. This isn't speculation, this is actuarial math. The average boomer is now 68 years old. The wave is already starting. Now you might be thinking, okay, but there are plenty of millennials ready to buy those houses. And sure, on paper that sounds right. Millennials are the largest generation, they're hitting peak earning years, they should be absorbing all that inventory, right? Except, here's where it gets interesting. Millennials are the most indebted generation in history. The average millennial carries about $87,000 in total debt, student loans, car payments, credit cards, and their home ownership rate is still below what Gen X and boomers had at the same age, not because they don't want to buy, because they can't qualify or they're too financially stretched to take on a mortgage that size. So you've got this coming flood of boomer housing inventory, and the generation that's supposed to buy it is already tapped out. That's a supply-demand imbalance, and it's not small. Factor 2, the commercial real estate collapse is spreading. Right now, office buildings in major cities are sitting 30 to 40% vacant. That's not a blip, that's a structural change from a remote work. And when those buildings lose value, the banks holding those loans take losses. We're already seeing regional banks pull back on all kinds of lending because their balance sheets are shaky. And here's what most people miss. When banks get nervous about commercial real estate, they tighten up on residential lending too. It's all connected. We saw this exact pattern in 2008. It didn't start with houses. It started with subprime, sure, but the contagion spread because the whole system is interconnected. Right now, you've got $1.5 trillion in commercial real estate debt maturing between now and 2027. A lot of that can't be refinanced at current rates. Defaults are coming, and when defaults come, credit freezes. When credit freezes, housing slows. It's a chain reaction. Now look, I'm not saying we're headed for an identical repeat of 2008. The mechanisms are different, but the underlying principle is the same. When credit tightens and inventory floods the market, prices don't just soften, they correct hard. Factor 3. Affordability is already broken. The median home price in the U.S. right now is around $420,000. The median household income is about $75,000. That means the average house costs 5.6 times the average income. A healthy ratio is around 3 to 3.5 times. We are way outside the normal range, and that's with mortgage rates still sitting around 6.5% to 7%. Let me put that in real numbers. If you buy a $420,000 house with 10% down and a 7% mortgage, your monthly payment is roughly $2,520. Add in property taxes and insurance, let's say another $600 a month, you're at $3,120. For a household making $75,000 a year, that's over 50% of their gross income. That's not sustainable. That's financial suffocation. And here's the thing most people don't realize. When affordability breaks this badly, the market doesn't just pause, it snaps back. Because at some point, buyers simply disappear. They stop qualifying, they stop trying. And sellers, especially the ones who have to sell, start dropping prices to find the buyers who are left. This is where it gets uncomfortable, because I know a lot of people are sitting on houses right now thinking, I'm fine, I locked in a 3% mortgage, I'm not selling. And that's true for you individually, but it's not true for the market. Because here's what happens next. All those boomers who need to sell, they're not emotionally attached to a 3% rate. They're 76 years old and moving into a condo. They're pricing to move. All those people who bought in 2021 and 2022 at the peak with 5% or 6% rates and are now underwater or breaking even, some of them are going to have to sell anyway. Job loss, divorce, medical bills, life happens, and they're going to sell at a loss if they have to, because they don't have a choice. So even if you don't sell, the market is filling up with inventory from people who will sell, and when inventory rises and buyers pull back, prices fall. That's not doom and gloom, that's supply and demand. Here's the part that separates people who build wealth from people who just survive financial cycles. Understanding that housing is not a one-way bet. For 40 years, we've been conditioned to believe that real estate always goes up. And over long enough timelines, sure, it tends to. But in the short and medium term, it absolutely does not. It crashes, it stagnates, it underperforms inflation for decades in some markets. Japan's real estate market peaked in 1991 and didn't recover for 30 years. 30 years! There are people who bought at the top in Tokyo who never saw their property return to the price they paid. That's not some distant hypothetical. That's what happens when you get a demographic collapse and an affordability crisis at the same time. Now, I'm not saying the US is Japan, but I am saying the idea that housing is a guaranteed wealth builder is a story we tell ourselves, not a law of economics. Let me give you a concrete example. Let's say you buy a house today for $450,000. You put down $45,000, 10%, and you finance $405,000 at 7%. Over the next 5 years, let's say the market corrects by 15%. Not a crash, just a correction back toward affordability. Your house is now worth $382,500. You've paid down maybe $25,000 in principal, so you've got $407,500 in equity in a house worth $382,500. You're $25,000 underwater. Meanwhile, you spent 5 years paying roughly $2,500 a month in interest, property taxes, insurance, and maintenance. That's $150,000 out of pocket. Add in your down payment, and you've put $195,000 into this asset, and you're underwater. Now, compare that to someone who rented for $1,800 a month and invested the difference. Let's say they saved $700 a month, the gap between rent and what the mortgage would have cost, plus that $45,000 down payment they didn't spend. Over 5 years, in a basic index fund averaging 8% annually, they'd have about $103,000. They're not underwater, they're liquid, they're flexible, they can move for a better job, they can pounce on opportunities. I'm not saying renting is always better. I'm saying the math matters, and right now, the math for buying is brutal in most markets. Here's the psychological trap, though. We've been trained to see renting as throwing money away and buying as building equity. But equity only matters if the asset appreciates. If your house drops in value, you're not building equity, you're catching a falling knife with debt. And this is where people make catastrophic mistakes. They buy because they feel like they should, because their parents told them real estate is always a good investment, because they're tired of renting, because they want the stability, the pride of ownership, the white picket fence. And look, I get it. Those are real emotional needs. But emotional needs don't change math, and the math right now is flashing red. Most people don't realize that the American dream of home ownership was engineered by policy, not discovered by nature. The 30-year mortgage didn't exist until the 1930s. The mortgage interest deduction was designed to stimulate housing demand during the Depression. We built an entire cultural mythology around home ownership because the government and the banks wanted us to. It's not some timeless truth. It's a financial product we've been sold. Now, look, if you already own a home and you're staying long-term, none of this matters much to you. You ride it out. Housing is cyclical. But if you're thinking about buying in the next year or two, or if you're trying to decide whether to sell now or wait, this is the most important financial decision you'll make this decade. Because here's what I think happens next. Over the next 18 to 36 months, we're going to see inventory continue to climb as more boomers sell, as more people who bought at the peak give up and cut their losses, as more commercial real estate pain leaks into the system. We're going to see prices soften in most markets, not everywhere, but most places, and we're going to see a lot of people who bought recently realize they're stuck. The ones who win are the ones with patience and liquidity, the ones who can wait for the correction, who aren't emotionally desperate to buy, who have cash or credit ready when prices actually drop. Because when this market flips, there's going to be a window, maybe 6 months, maybe a year, where you can buy real assets at real discounts, but only if you're already buried in a property you overpaid for. This is the part where people say, but what if I wait and prices keep going up? And sure, that's possible. Maybe I'm wrong. Maybe inventory gets absorbed faster than I think. Maybe rates drop to 4% tomorrow and everyone rushes back in. It's possible. But the thing is, the downside of waiting is you pay a little more later or you rent a little longer. The downside of buying at the wrong time is you lose years of wealth building potential. You're trapped in a depreciating asset and you might not financially recover for a decade. The asymmetry matters. The risk-reward is not balanced right now. Here's what I'd do if I were sitting on the sidelines today. I'd rent in a good area, keep my housing costs low, and stack cash. I'd put that money into investments that are liquid, index funds, bonds, whatever matches your risk tolerance. I'd wait. I'd watch inventory. I'd watch price cuts. And when the market actually corrects, not when people say it's correcting, but when you see real sustained price drops over 6 or 9 months, that's when I'd move. And if I already owned, I'd honestly think hard about whether this is the time to sell, not out of panic, but out of strategy. If you've got significant equity, if you've been in your house for 5 or 10 years, if your local market is still near peak prices, this might be the best exit you get for a long time. You sell high, rent for a couple of years, and buy back in lower. Yeah, you pay some transaction costs, but if the market drops 20%, you come out way ahead. The people who build serious wealth don't follow the crowd. They don't do what feels safe or what everyone else is doing. They look at the actual data, they understand the cycle, and they move when the opportunity is real, not when the pressure is high. Right now, the pressure is high. Everyone's saying buy. Agents need commissions, sellers need buyers, the whole industry needs transaction volume. But the opportunity is coming. It's just not here yet. The housing market is about to flip, not because of some conspiracy or crash, but because the fundamentals are broken and the correction is already in motion. The only question is whether you see it coming or whether you're the one caught holding the bag when it does. Stay smart, stay liquid, and don't let fear or FOMO push you into the biggest financial mistake of your life.